It's great to be with you today. My name is Arlan Suderman, Chief Economist, Commodity Economist with StoneX. And we're going to take a look at the latest outlook for corn and soybeans and see how USDA's latest report may have impacted that, talk about some of the factors that are going to be shaping the supply and demand factors as we go through the months ahead. First of all, as I get started on this, I need to make sure that I put the disclaimer up there and give you an opportunity to read that and make my compliance department happy. But it's been an unusual year overall for the grain and oil seeds. I guess I should say an unusual couple of years. We've had a number of things that have hit us. First, it was the trade war, and then it was African swine fever in China. Those were kind of simultaneous, and then we had the pandemic. So a lot of factors coming together at once that have really kind of upset the apple cart, so to speak, in shaping how grain and oilseed production and trade has happened around the world and the demand that's happened. We're starting to kind of settle down on some patterns now, and we'll take a look at that. I always tend to start my presentations with this slide. Price is a function of supply and demand, but is modified by the flow of money. And those of you who have heard me before have seen this slide before, but it still holds true, and it's especially held true here over the last couple of years and even in recent weeks and months. The flow of money has an impact on how the markets manage supply and demand. Supply and demand still matters, and it ultimately does shape the price. But that flow of money and whether the funds are bullish to commodities or bearish to commodities tends to have an impact on prices all the way down to the farm gate. Now, one of the things we've been watching here lately is inflation, because during times of inflation, the funds tend to buy the commodities as a hedge against inflation. And we see here what this is the 5-year break-even inflation rate going back to really 2003. And you see that inflation expectations tend to hover either side of that 2% level that the Federal Reserve likes to talk about. That's their benchmark target rate. It goes either side of that. Then when we had the Great Recession in late 2008 into 2009, those inflation expectations actually went negative, which means deflation. And the commodity markets collapsed then as well as money flowed to the sideline amid the uncertainty. And then we recovered back fairly quickly, got that inflation rate back up either side of 2% again. The pandemic saw us drop sharply once again there on the right of this chart. It didn't go negative, so we didn't have deflation, so to speak. Maybe in individual commodities, individual assets we did. But as a whole, we did not see deflation. It was a really short recession, kind of a man-made recession, if you will. It may be redundant to say that. But it was where we intentionally shut down the economy because we didn't know what to expect out of this pandemic. Then as we learned how to manage the pandemic, we reopened the economy over time, and we saw the money coming back in and demand for commodities come back as well. Now, here is a look at the CRB index, which is one of these baskets of commodities from a number of different sectors. Now, the CRB is a little bit more heavily weighted toward the energy sector, but also it has a considerable sector that's in the ags as well. And we saw the last big commodity cycle that happened, and it was really peaking in 2008 when the Great Recession hit. So money flowed to the sideline while the funds tried to figure out how bad of a structural damage we were doing to our domestic and global economy. And then it was in late March of that year when on March 29th, I remember, where the VIX fell back below 30. That's Wall Street's fear index. And money started flowing back into the commodities once again to resume the normal cycle, although we were on the backside of it by that time. And then you'll see the dip we took during the pandemic. We were already at much lower levels. Now, if we put the two together, this is the 5-year break-even inflation rate, which is the light blue color there, and our StoneX commodity index, which is kind of, it's not it's the same type of tool as the CRB, but it's our StoneX brand of commodity index, or basket of commodities. You can see how they flowed together really over the last 8 years or so, and kind of the correlation you see there. Now, when things are kind of stagnant, the correlation breaks down, but when we have big movement in inflation expectations, either positive or negative, then the correlation becomes much stronger, almost a one-to-one type of a correlation, almost a perfect correlation. So inflation expectations matter. We had high inflation expectations coming out of the pandemic, and we saw the grain and oilseed prices really surge and peak in May. And then they kind of chopped sideways in an ever narrowing type of a trading range through the summer, and then broke to the downside out of that trading range as we approached the end of the growing season. But where do we go from here? We saw data showing earlier this month that the producer price index is still going up on a year-on-year basis, topping 7%. So inflation is still very real. Excuse me, will that bring the money back into the commodities? And I would suggest that if they develop a story, then we'd have a high level of confidence that they will. If they don't ever develop that story, you know, a bullish story, weather event or demand or whatever, that yes, they'll be present. They won't be short like they were the previous 2 years as straight and net short positions. But they'll have enough ownership in there to kind of keep the price of the commodities at an elevated plateau level as long as inflation is a factor. Now, let's move into the fundamentals with that as a backdrop. I mentioned earlier African swine fever and China's hog herd. Now, as of 2017, China fed over 700 million hogs per year. That's more hogs than the rest of the world put together. So it's a pretty significant sector of the world hog population. African swine fever is identified in China in August of 2018. And that is when everything started to break loose. Now, we don't go by China's official data because we don't have confidence in it. We have people on the ground in China, both customers, and we have staff on the ground in China, employees on the ground. So we take information, we get them and what they see on the ground. Now, that's still a lot more difficult to really have confidence in than what it is maybe here in the States or another country that's more open, because even in China, people are becoming more afraid of speaking. But it does give us some sense of what's happening. And we, based on that, we feel like hog feeding was slashed by 60 to 70% at the peak of the ASF outbreak. Now, China says they've basically brought that production back to where it was prior to the ASF outbreak. We believe it's somewhere down 15 to 20% from that yet. But yet demand for feed and feed protein, soy meal, is back to essentially where it was before, because they have banned the use of food waste as a food source for hogs in China. So as they rebuild their hog herds, that means they need a lot more corn or feed wheat and soy meal or whatever they're feeding, the grains and oilseeds, in order to get the same amount of pounds of pork. Now, you see here on the left chart how the price of hogs has really plummeted here over 2021, basically. The plummet really started kind of in January into February, and it's kind of started to stabilize now back at levels where it was pre-ASF. Same thing with the price of pork. And yet you say, well, you told me that we weren't back to pre-ASF levels of production yet. Yeah, the difference being that we still have a lot of imports going into China at this point yet. And the fact that those high prices that you see there, those record high prices, move some people away from pork toward other protein sources like beef, mutton, aquatic food, etc. And so now China's trying to push their consumer, encourage their consumer to go back to pork to reestablish that demand factor for the pork. And so that's going to be one of the keys going forward for demand for grain and oil seeds. whether it be export or whether we're producing it here and exporting the pork. Are we going to export the feed or are we going to export the pork? So that's going to be one of the key factors. Now, when you look at feeding margins on the right, they're really struggling. And so what this is doing is the big commercialized firms that, yeah, they have higher costs because they have all these biosecurity measures in place trying to keep out African swine fever, which is definitely still there. But they also have the efficiencies of size and a little bit lower risk because they do have those biosecurity factors. And so they're able to continue restocking and even expanding in some cases, while the small producer doesn't. So what we're doing is we are the continued presence of ASF combined with these poor feeding margins is continuing to rapidly evolve the hog industry in China away from primarily small family farms toward large commercialization. And China, the government, I think, sees this as a benefit. It should be able to provide more stability in hog production over the long term and food production, essentially, since pork is still the favorite food in China. Maybe rice is obviously maybe the most consumed, but pork is the most desired food in China, fresh pork, that is. But also helps in control disease and a number of other factors and provide a more stable supply of food. So it is leading to that. Now, one of the things China watches closely is this live hog to corn price ratio. It wants to keep it above 5.5, but below 8.5. And right now with corn prices coming down and hog prices low yet, it's really hanging just below that 5.5 level, really close to 5 level. So that's uncomfortably low for the government. They're trying to do things to buy pork for the reserves, convince people to eat more pork, etc. They want to get that elevated, but at the same time, they haven't done as much as maybe what their rhetoric says because they like the way it's becoming more commercial. And in the end, I think that's going to be better for U.S. corn and soybean shipments to China and for the demand base for that. Maybe not so much for U.S. pork exports, but maybe for the product exports. Excuse me, the feed exports. Now, as we look at crush margins for soybeans, they've been working their way higher, and we have some positive crush margins now. And I think part of that also is with the commercialization of the hog herd there. That is certainly improving things. And so it's the progress is slowed now that we got positive because we still do have those low margins, but it is moving back in the right direction. And we've seen an overall trend toward higher weekly crush rates. So another factor, and here again, it's China, because China is the big factor in the commodity world right now. China wants to fill its stands with people when it hosts the Winter Olympics in February. And as such, it has maintained a zero tolerance policy toward COVID. Now, it's gotten a lot of criticism for that. It's increased port congestion, increased costs for consumers around the world, but in the process, it has been able to keep control of COVID. And that has worked for it. Its case numbers are very low, and it's maintained that intolerance to COVID. Electronic tracing is used. In other words, if you're riding the train to work and you happen to walk past somebody who tests positive 2 days later, you're probably going to get notified that you need to go into quarantine and testing. People have gotten used to that in China. But still, when there are outbreaks, it does quickly kind of shut things down, which reduces demand for commodities, be it energy, be it consuming pork. They tend to eat less meat when they're staying at home, etc. So we do have this ebb and flow with each outbreak, but they have been able to control COVID in this way, albeit at a cost. But the risks are to energy and meat consumption. Now I'm going to bring it back home a little bit. We've taken this look at China as the major demand factor in the world for the grain and oil seeds. We get the USDA updated its corn and soybean yield estimates, and we thought it'd be interesting. We did our non-scientific Twitter survey, and asked people on there, what do you expect USDA to do with their September corn on the top and soybean yields going into the report? And the general bias was that the yields would stay the same or be higher for both corn and soybeans. And USDA didn't disappoint. That's what happened. And in fact, their corn and soybean yields went up by a little bit more than what the trade anticipated, but I think less than what the trade feared. Now, we also saw an increase in corn acres, but it was less than what was feared as well. The FSA data that was released inadvertently, if you recall, ahead of the report, the WASDE report, you could have interpolated that maybe we'd get closer to 1 million acres more corn, but USDA WASDE went with 500,000, actually 600,000 acres, and that's probably a pretty good number. There'll probably be another adjustment or two in that, but I think this is probably the largest adjustment we're going to get. Whereas soybean area came down by 400,000 acres, which is kind of what we saw when we looked at the August FSA data as well. Now you'll notice our estimates at the bottom, and these are estimates. We don't estimate USDA, we estimate final. Now that may change each month as we do customer surveys, etc., but we're always keeping our eyes toward the final. And so USDA's yield numbers were a little bit below ours, a little bit above the trade, but really within expectations. And so when the report came out, we got the initial reaction, and it's kind of a sigh of relief by the market. And there were some technical factors in there as well at play. But now it's going to come down to what the harvest results say. Now, new crop ending stocks, when you look at corn at 1.48 billion bushels, that's not real big. It's right around that 10% stocks to use ratio, and I'll look at more specifics here in a little bit. But at the same time, we can't let our guard down too much. Supplies are rather tight, and I'll have the graphic on that as well. So it doesn't really argue for rationing with higher prices, but the margin for error is pretty small. Same thing with soybeans at 185 million bushels. Our numbers are a little bit lower for soybeans, a little bit higher for corn, not really materially different though as we go forward. And on the global side, this is where USDA's numbers came in considerably above expectations for the corn and modestly for the soybeans, but the trade really didn't seem to be too upset about that overall, kind of believing that those numbers are probably the highest we're going to see in a while. If we look at the corn yield, really came in pretty close to that 30-year trend yield. That 30-year trend yield comes in around 176.5, so pretty close to that. People draw their trend yields lines differently, but USDA here using just a straight linear trend, and I found that works well for me as well. That's what I like to do as well. When you look at this month's change in yield versus the previous month, you see the current yield at the top number in each state, and below it, you know, the mind, at least my mind, tends to think, okay, the bottom number is the change in yield. No, it's a change in yield as a percent. So keep in mind that's not bushels, that lower number. That lower number is a percent change. So Iowa went up to 198 bushels per acre. That's up 2.6% from the previous month. So we basically see USDA increasing the yield from last month. Nebraska, Iowa, Minnesota, North Dakota, where there was quite a bit of rain in late August and early September. South Dakota got quite a bit of rain too, but USDA didn't increase that. I found that interesting. And Illinois just kind of stayed flat. That's going to be something to watch, particularly Illinois, Indiana, and Ohio. Ohio did drop a little bit while Indiana went up 1.5 percentage and a half. Really, if you get east of the Mississippi River, I'm hearing a lot of anecdotal reports about the fungicide treatment on the corn just kind of running out of gas before kind of losing its protection before the crop was done. And so, and we were also pretty warm for the finish, above normal temperatures overall. So it'll be interesting to see what final seed size comes in, whether we see this yield come back again. Typically, we say big crops get bigger. If it goes up from August, September, then October is going to be bigger, November as well, and the opposite is true as well. But I don't think we can go by that anymore, because we used to always see the first objective field surveys in August. Now we see the first ones in September. So I think the trend is actually starts in September, not in August, and we'll see what October does rather relative to September versus September relative to August, because we've really changed our methodology, USDA did, in determining its September yield versus August. And so I don't think we can just assume that we're going higher in October at this point. And the agronomist in me, yes, I was an agronomist in a former life, excuse me, is really worried about kind of how we finished and how late the rains came in that process. Now, if you look at the blue bars there, that's ear populations, and this is data going back the last five years. And the red dot then is the USDA's yield estimate. And it's kind of giving us a track record here of September, October, November, and final, and you can see how they correlate. But look at 2017. And generally, once they get the ear population, obviously that doesn't change much from month to month. But the yield estimates do. In 2017, we had almost a perfect grain fill period in August and early September with cool temperatures and a lot of rain. And so the yields kept climbing because seed size kept growing. And 2020 and 2018, it was different. It was less desirable grain fill weather, and yields kept going down as the ear population stayed the same. So my bias is more that that's where we're going to be going in future reports, but we'll see. Total corn use, interesting to see that basically export demand has stayed relatively stable over the years. We've just lost market share to other parts of the world. It's particularly high prices of 15 years ago, bought a lot of production in the Black Sea and especially Brazil. And we've also obviously dramatically increased our biofuel demand for corn. And you see that here in looking at ethanol, while exports stay relatively flat, as does feed use. As we look at world stocks, these are USDA numbers. I would still argue, based on our boots on the ground China, USDA is overstating Chinese supplies, maybe as much as 49 million metric tons. Now, when you remove China from the balance sheet and remove the United States, that leaves the rest of the world with a 35-day supply, and that's the tightest in 20 years. We just don't have any margin for error there. Now, if you look at the top corn exporters, you see here the growing influence that the Black Sea, particularly Ukraine and Brazil, has had in recent years in grabbing market share on a world basis. This graphic quickly shows where the poorest corn is in the northwestern parts of the belt. The best corn has been really southern and eastern parts of the belt, and it's been an argument all year long how the good and the bad are going to balance each other out. And so far, much to the frustration of those in the Northwest, it's balancing it out pretty well, but I still think we're going to end up a little bit below trend. We need to really be below a 9% stocks to use ratio to really see the escalation of prices as we try to ration demand. Right now, USDA has us at a 9.5%. Here again, the current marketing year that just began this month in September is right here. Oh, excuse me, it is in the second column, a 9.5% stocks to use, 1.48 billion bushels. The next two columns is my old crop and my new crop estimate. And by new crop, I mean this new marketing year that just started. And I have ending stocks at 1.5 billion bushels even. That's a 10.1% stocks to use ratio. And then I've even included the 22-23 marketing year, two alternatives for that. One with a little lower yield because of high input costs, and the other with a, excuse me, not yield, but acreage, and the other with a higher acreage, but with a trend yield of 179 on both. And you can see how I see stocks slowly building in the coming year, particularly if we see acreage go up. But if acreage goes down, then stocks stay relatively tight. So this is something we're going to be watching closely. My bias is the first alternative there, that soybeans are going to buy some acres away from corn next year because of high fertilizer costs. We look at soybean yield coming in a little bit above trend, and you see a little bit more mixed bag here on what yields did from the previous month. With soybean pods, we don't see quite the correlation to kind of the fill period like we did in corn, but it is still there. But if you look at 2017, it was in the opposite direction. So this is something we're going to watch. I don't like the way the soybeans looked when they matured, but I don't have a strong conviction. I think we're going to be dropping lower in bean size into pods, but we'll have to see. Demand really flattened out in China with the African swine fever, but we're starting to bring it back. And these are USDA numbers, but I'm about 3 million metric ton above USDA on imports for the coming year. The next month, next few weeks really are going to tell us a lot about whether I'm wrong about that or not. One of the great stories, though, in the oil seeds is these new renewable fuels. You've heard me talk about them before, but we're seeing a lot of processing capacity opening up in the fourth quarter of this year, the first quarter next year, if more plants in process in various stages of process, going to be increasing demand for the edible oils, just really changing the dynamics of the oilseed market. With soybeans, we start seeing more of an escalation in price below that 7% stocks to use ratio. Again, the poor crops are in the northwest, better crops to the south and the east. We look at the balance sheets, USDA is calling for a 4.2% stocks to use ratio. I'm tighter than that. USDA came toward me in a lot of these numbers in the September report, but I still have higher crush numbers for the coming year and a little higher export numbers as I look at the demand structure. I probably need to cut my crush a little bit as I look at this. I wanted to leave my estimates the same as what they were before the USDA numbers, so you can see how I went into that USDA report. If they were going to ration somewhere, it would be on the crush side yet at this point, probably working more toward a 3.5% stocks to use ratio. But I'm more bullish on the demand side and particularly on the export sides, unless Brazil has a bumper crop this year. And with La Nina, that's redeveloping those cool waters off of the west coast of South America into the equatorial Pacific. That may be more of a challenge here in the months ahead as we're looking at being in a La Nina, weak to moderate La Nina for the South American growing season for their summer. We've still got that drought in the Midwest, northwestern Midwest, even with the recent rains, that we need to keep refilling those soils for next year. And we look at Brazil, we tend to see with La Ninas dryness over Argentina and southern half of Brazil. We can also tend to be either dry or wet in the center west region of Brazil, depending on the La Nina. The correlation is much weaker there. The key now is to see when the rainy season returns so they can start planting soybeans again. Not only does that impact their soybean season and how long our export season is, but it also impacts, as we saw last year, when they're able to plant their safrinha corn crop and how much at risk it's going to be. So kind of the take-home points from the corn and soybeans is USDA's acreage and yield adjustments were pretty much within the trade expectations. The focus is now going to be on harvest returns, the combine results. And over the next 10 days, we should start seeing a lot of that come in. Is it higher than expected or lower? Now, La Nina's return does keep supply risks in play. And so that's going to be something to keep an eye on, particularly with Argentina and southern Brazil. Now, China has stated that they're seeking self-sufficiency in their grain and oilseed imports. That can't happen for soybeans, and I don't think they're even going to try on that. But they want to be 95% self-sufficient in corn. We think it'll be closer to 85%. So I'm looking for a little bit of a dip in corn imports for China over this coming 12 months to maybe 20 or 22 million metric tons, and then a push higher to maybe 30 or 35 million metric tons a year from now. So coming back again with that to fill that deficit. U.S. global corn, both U.S. and global corn soybean stocks I expect to remain relatively tight over the coming year unless we see some bumper yields someplace that aren't currently expected that could help rebuild supplies. So that's kind of an overview as I see it of corn and soybeans.